Welcome to GRE. I'm your host, Keith Weinhold. Why would you ever sell a cash-flowing property? One answer is to do a 1031 exchange. Structured correctly, it's how you'll never have to pay 1 penny of capital gains tax your entire life. This is how you really can make millions of extra dollars on your real estate throughout the course of your life. It's all about 1031 exchanges today on Get Rich Education. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the number one lender for beginners and veterans. Start your pre-qualification, chat with President Shaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com. Checkbook IRAs have been ruled illegal by the U.S. tax court. With contribution limits 10 times what traditional and Roth IRAs allow, get total control of all of your IRA funds without paying the nasty UBIT tax with the retirement plan answer left standing, the EQRP. You can invest your retirement funds in real estate, gold, Bitcoin, and even your own business. This works whether you're a solopreneur or have up to 50 employees. Learn more about getting started. Text EQRP in all caps to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Portland, Maine to Port-au-Prince, Haiti, and spanning 188 nations worldwide, this is GRE, and I'm Keith Weinhold. Yes, my slack-jawed act is back on track for another wealth-building week, the 387th in a row. In fact, yes, you may very well want to take a cash-flowing property of yours and get rid of it. That's because you can exchange it up, tax-deferred, for a larger property or for two properties, which create more cash flow for you. Yes, you can make millions of extra dollars in your life with 1031 exchanges. In fact, on my first exchange, I traded out 8 apartment units that provided $1,500 of monthly cash flow into more apartment units, a larger property with 19 units that created $3,500 of monthly cash flow, all while at the same time adding little or none of my own outside money into the deal and owning a higher dollar value of real estate overall and moving from 2.5 times leverage on smaller property up to 5x leverage on larger property. And that's what really makes your growth multiply. So yeah, over the course of your lifetime as a real estate investor, you can make millions of extra dollars with 1031 like-kind exchanges. That's the full name of them, also known as 1031 tax-deferred exchanges. Yeah, millions.
You're talking to the Rolex wearing, diamond ring wearing, kiss stealing, wheeling dealing, limousine riding, jet flying, son of a gun.
That's so ridiculous. Well, we approach things more modestly than that here. That sounds like vintage pro wrestler Ric Flair right there. Now, alternatively, rather than a 1031, with a cash out refi on a property, that can be really good for you. You get to keep a winning property if you've got a real winner and still pull out some cash tax-free. Although one catch there with a cash out refi is that you often must leave something like 30% equity in the property, but a cash out refi could still be right for you. Yeah, if you've got that really strong performing property. But one way to get all of your zero rate of return equity out of a property is to sell it with a 1031 exchange and have the ability to reposition all of it, maybe with a only 20% or 25% down payment on your replacement property, and you can enjoy endless tax deferrals over time because there is no limit to the amount of times that you can just keep exchanging up and exchanging up for more and larger property just this way. Yes, all your life, no limit. That's the advantage that a 1031 has. And another way that 1031s really tilt in your favor is if you want to peel off a dog, if you've got a poor performing property for some reason. Yes, you and I, as investors long term, we're almost surely going to have some of these underperforming properties. Or maybe you want to do a 1031 because your property has some major maintenance items due soon. Okay, that could be another practical reason for you. Now, say that you've had equity accumulating rapidly in 2 single-family rental properties that you own, and you want to trade them up for 1 fourplex. Well, now with that, you will have 2 more doors. You'll actually have 1 less property, hence 1 less loan, and therefore you freed up 1 more of your golden ticket loan spots, of which you get 10 max single or 20 max married, like Chaley Ridge and I discussed here last week. It's been a few years since we did an episode on 1031 exchanges here. The only other time was back in GRE podcast episode 143. That was a while ago. So I thought that it was time to really help you with this extremely advantageous tax benefit here this year again, because so many investors are equity rich today with the torrid housing price appreciation run-up of the last, year and a half or so. Yeah, chances are quite high that you are equity rich today. And although this topic is not difficult to understand, I still consider this to be an advanced real estate investor topic. And that's because it almost certainly means that you've owned rental property for a few years and that you are ready to trade up. And fresh beginners simply are not in that position. But if you happen to be a fresh beginner, you're going to know about this tool. You're going to know what comes next and how good that it gets. Yeah, in fact, I'll say that when you do a 1031, I'm going to dub you as a real real estate investor. Yeah, a real real estate investor. In fact, years ago, when I was at my local real estate investor meetup, and this was our topic, the presenter at the front of the room asked how many people in the room have ever done a 1031 exchange, and there were maybe 40 people in the room that evening. Only 2 people raised their hand. Those 2 people were the presenter at the front of the room and me sitting in the audience. So this is something that people often hear about and fewer people really know about, and I think fewer people even do it. I am going to change that today and make this topic approachable for you. Let's learn about one of the biggest gifts your government is ever going to give you. It's a gift that I suggest you consider accepting. A CPA and partner at Shell & Hogan, this week's guest specializes in corporate tax and as a qualified intermediary for 1031 exchanges. He is based in Georgia. Welcome to GRE, Steve Graham.
Thank you. Good to be here.
It's so good to have you. Now, I think a lot of people know sort of the basics of a 1031 exchange. That's how we avoid paying real estate capital gains tax when we sell a property and avoid paying depreciation recapture. But just at the most basic level, Steve, when someone asks, what is a 1031 exchange, what do you tell them?
A 1031 exchange is where you're selling a piece of real estate and buying a replacement property. And if you don't want to pay tax on that gain, you can defer the gain into the property that you're purchasing. And so in its basic terms, that's what a 1031 is.
Yes, and certain types of property qualify for a 1031 exchange, and then other types do not. I think most people know that a 1031 exchange is not used for one's primary residence for that typical owner-occupied property. So tell us about the types of properties that do qualify for this 1031 tax-deferred exchange.
The tax rules used to be that 1031 exchanges could be done for real property or personal property. So people used to swap things like boats and airplanes and stuff like that.
Cattle.
Business property like that. But they did away with that a few years ago and made it just real estate only. So it's got to be real estate. You've got to be selling real estate and buying other real estate. But you can sell like rental property and purchase vacant land, or sell a vacant land and purchase farmland or timberland. It's really any property that you don't use personally. So it can't be your primary residence and it can't be a second home. Now, there are ways to make a second home qualify, and we'll get into that later on. But the general rule is that it's all real estate that is not being used personally.
The 2017 Trump Tax Cuts and Jobs Act removed some pieces that qualified for a 1031 exchange, but Trump, being that real estate president, he did make sure that benefit continues to exist for real estate investors. But a lot of people think that it's only for residential real estate, but like you touched on, it's not. It can be used for other things. You can exchange out of residential real estate and into raw land, or into warehouses out of residential real estate, or whatever. It's not for foreign property, and it's not for things like mortgage notes. So we are talking about just real property. Is that right, Steve?
That's correct. Yeah. Just U.S. property, and it's got to be real property.
When a lot of people talk about 1031 tax deferred exchanges, also known as 1031 like kind exchanges, because you're exchanging for other property that is similar in kind, I think most people think about what you would call a forward exchange. So can you talk to us about that most basic type, Steve, what we think of as a forward exchange?
Yeah, there's actually two types of those. One is what's called a simultaneous exchange. And this happens occasionally, but not very often. It's where you have a property that I want and I have a property that you want, so we just swap them directly. Well, once in a while that works out, but a lot of times it's not like that. It's like you have a property, or I'm selling a property and I've got a property that somebody else owns that I want. So in that scenario, you do what's called a deferred or delayed forward exchange. And in that case, you have to have an intermediary, and that's where I come into the picture. So with these delayed forward exchanges, what happens is I get a copy of the sales contract on the property you're selling. We draw up some paperwork. I touch base with the closing attorney, and at closing, they pay the selling expenses and the mortgage if there is one, and the net proceeds that they would ordinarily pay out to you. Instead of doing that, they wire it into my escrow account.
And this is important. The seller is not touching those funds.
Right. That's a key factor, because the seller touches the fund, it's tainted, and the transaction can't be an exchange.
Right.
So the funds go into my escrow account, and then from the day that you sell the property, you've got 45 days to identify potential replacement properties. You can identify up to 3 properties, in certain circumstances more, but always at least 3 properties if you want to. Or if you know the property you're going to purchase, you can just identify 1 if you want to. That's the 45-day identification period. And then whatever properties you're going to purchase, you have to buy them within 180 days of the sales price. So both the 45 and the 180 days start on the date of sale of the property that you're selling. So what will happen after you sell the property and you identify your replacement property, the sales contract on the property you're going to buy, draw up more paperwork, and then touch base with the closing attorney there. And when you buy the property, I'll wire the funds directly to the closing attorney. The fact that you never touch the money, and the fact this paperwork that I do makes it qualify as an exchange, even though you're really selling one property and buying another. The IRS has said that they would accept it as an exchange if you do these things.
Yeah, this is a good distinction, because most forward exchanges are not simultaneous exchanges. I've never done a simultaneous exchange. I've only done what I would consider the plain vanilla exchange, which is a delayed forward exchange. Yes, having that 45-day identification period and 180-day period on which to close on the identified replacement properties. So to give a simple example, if I go sell a property January 1st, let's say 45 days later is February 15th, I would have until February 15th to identify qualified replacements for the equity from that relinquished property to be moved into. And then by July 1st, saying July 1st is 180 days or so after January 1st, it's probably not exactly that, but just to give an example, it is by July 1st in which I would have to close on one or all of those identified replacements, that 180-day period on which to close on the replacements. I know that part of the rules, Steve, and I'm a person that has done a number of 1031 exchanges, but I don't quite do it every year. I seem to remember that when you identify properties in that 180-day identification period, you have either the 3 properties rule, the 200% rule, or the 95% rule. And the person that's doing the exchange needs to pick from one of those 3 when they identify the properties. Is that still right? And can you speak to that?
Yeah, that is. In most cases, people will use the 3 property rule. That's the simple,
that's what I usually use.
Standard rule. But if they want to identify more than 3 properties, then they could use one of the other rules. And the second rule is the 200% rule. So what that one says is that you can identify more than 3 properties, but the total value of all the ones you identify can't be more than twice the property that you sold. So if you sell a property for, say, $200,000, then twice that is $400,000. So you could identify, say, 4 properties that were each $100,000, and that would work because the 4 properties are not more than twice the sales price on the property you sold. So that's a way that you can identify more than 3 properties, but the numbers have to work out to where you're not identifying more than twice the value of the property you sold. One other thing that I didn't mention before, and I'll jump back to, is on the 45 and the 180-day rules. Those are calendar days. So if the 45th day falls on a Sunday, it's Sunday at midnight is the day. A lot of people think, well, a lot of the tax rules are written to where if it falls on the weekend, you've got until Monday, but these are not like that. If it's the 45th day, it's on that day.
All right. These are calendar days. So the 3 means in which to identify replacement property are the 3 properties rule, the 200% rule, which you spoke to. Can you tell us about the 95% rule, that third option? I think it's the least used option in a delayed
it is. The 95% rule says you can identify as many properties as you want, but whatever you identify, you have to purchase 95% of the value of those. In my example, if you sold for $200,000, you could identify 6 properties to replace it, but you would have to purchase all 6 of them because you couldn't purchase 5 and get to the 95%. So that is rarely used. But yeah, you can identify more than 3, but you basically end up having to buy all the properties or virtually all the properties you've identified.
When we talk about the point of doing this, to stick with your example, if you, the seller, sell a property and have a $200K gain and you move it into any of these identified replacements within those 45 and 180-day timelines, you do not owe any capital gains tax or depreciation recapture on it. So therefore, if you had a $400,000 property with $200K of equity in it and you're up to 50% equity, you could go ahead and move that full $200K without having any parts chipped off of it for capital gains tax and position it as a 25% down payment into an $800K property. So here you go. You're increasing your velocity of money. You could be increasing your cash flow because you're getting into a larger property, and you're increasing your leverage ratio from 2-to-1 up to 4-to-1, all at the same time, tax deferred. So we're talking about a delayed forward exchange here with Steve Graham of Shell and Hogan. They're a 1031 exchange QI, a qualified intermediary. But Steve, tell us about reverse 1031 exchanges.
These are a little bit different in that if the structure of the transaction is that you have to buy the property you're buying before you can sell the property you're selling, you can do what's called a reverse exchange. And in order to do that, the intermediary ends up setting up a separate entity, an LLC, and the LLC ends up buying the property you're going to buy. And then you would have to loan the money to the intermediary in order for the intermediary to buy that property. And then when you sell the property, the intermediary will transfer the money to you. They're a lot more complicated. There's a lot more paperwork involved, and they're a lot more complex, and legal documents have to be drawn up. So we don't run into nearly as many of those as we do the delayed forward exchanges, but they are out there. And if you can't get the timing to work out right for a forward exchange, then you might have to do a reverse exchange. A lot of times you can structure an exchange that looks like it's going to be a reverse exchange. You might be better off to get the other party to delay the closing, even if you have to pay them a few $1,000s or whatever. That might work out to be less than the additional QI fees to do a reverse exchange because they're a lot more expensive.
Talk to us about the pros and cons of reverse exchanges. See, I would imagine that one would, since they're not relinquishing a property first and they're closing on that replacement, they would need to have extra cash. They would need to be sort of cash rich in order to buy the replacement property before they relinquish one.
Right, they would. And that's one of the reasons why we don't see nearly as many of these, because you have to fund the purchase of the replacement property before you get the funds from the property you're selling. So you've either got to have a lot of money to put into it or borrow money unsecured to put into it.
Are you afraid that you pay too much in taxes and the IRS has taken too big of a bite of your dollar all your life? Well, guess what? Real estate investors have one of the biggest advantages, one of the most generous incentives from the IRS known. It's called the 1031 exchange. We've got more to discuss about 1031s, including strategies for converting non-qualifying property like second homes and vacation homes. Can you make those qualify for a 1031 as well? You're listening to Get Rich Education. Our guest is Steve Graham. More when we come back. I'm your host, Keith Weinhold. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both, Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant-resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner and Alaska and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's build the number 2 rentdirect.com or text 407-927-5074.
This is Rich Dad Sales Advisor Blair Singer. Listen to Get Rich Education with Keith Weinhold, and above all, don't quit your daydream.
Welcome back to Get Rich Education. We're talking about one of the greatest gifts that Uncle Sam gives to real estate investors, the 1031 like-kind exchange, where you can infinitely defer your taxes throughout your life over and over and over again. And then upon your death, your basis steps up such that your heirs don't even have a tax obligation either. Steve, that's why a lot of people want to try to get and obtain properties that qualify for this great benefit. So can you talk to us about some of the strategies outside of just income property for how one can convert property to qualify that might be a second home or a vacation home and make that 1031 eligible?
Second home normally does not qualify for 1031 treatment because it's a property you're using personally. So what you can do if you have a large gain in a second home and you're willing to wait a little while to sell it and to buy a replacement, you can rent it out for a period of time before you sell it. So if you rent it out for, say, 6 months to a year, then you've converted that use from being a second home to being a trade or business property as a rental property. So then you could do the exchange, buy a replacement property, and of course it has to be trade or business property too. So you would have to rent it out for a period of time, another 6 months or a year. But then at that point, you can take it off for the rental market if you're so inclined, and you could start using it as a second home. So that's a way that you could move from one second home to another second home, both of which normally would not qualify for a 1031, but you can make it qualify by doing that, by changing the character of the property to a trade or business property by renting it out for a little while. So that's a technique we use. Another one is if you have a property you want to eventually live in, you can do the same thing, rent it out for a while, do a 1031 exchange, then rent out the property you purchased, and then you could move into the property you purchase. And so you could convert a second home into a primary residence and avoid the tax by doing that as well.
As we also know, primary residences have their own capital gains tax exemptions up to certain thresholds. This would be something different than a 1031 tax-deferred exchange.
Yeah, that's right. And so this is the strategy I just talked about would work for selling a second home and then buying a replacement property and moving into it as your primary residence. And then if you live in it for 2 years and own it, it'll qualify for principal residence exclusion rules.
Right. Well, sticking with the 1031 tax-deferred exchange, there are some related parties rules around this for one to be mindful of. Can you speak to those?
We often have people who want to sell a property and they might be selling it to a brother or something like that. And that will work. But the only problem with it is to do that, both parties have to keep the properties that they end up with for 2 years. You could do the 1031, you could sell the property to your brother, take the proceeds and buy a replacement property. And then as long as you held that replacement property and your brother held the property he bought from you for 2 years, that works as a 1031 exchange. Now, the problem is if your brother gets an offer he can't refuse within that 2-year period, he could sell his property and it would cause you to have to pay tax on your 1031. So he needs to know that he can't do that. He can't sell the property for 2 years because it'll cause gain to you. And so that'll work, though, as long as he's aware of that. Now, on the other side, if you're buying a replacement property, you can't buy from a related party because if you do that, the related party ends up with cash and you end up with their property. And so the 2-year holding period doesn't work when they're holding cash. There's got to be property that they end up with. You can sell to a related party if both people hold the property for 2 years, but you can't buy from a related party.
I learned a little something there. That's a wrinkle I did not know about. Steve, sticking with this $200K of gain example, if someone had a $200,000 capital gain from the sale of a property, can you talk to us about the term boot? We're talking about that sum of money that would not be included in exchange and therefore would be taxed. Because if someone has a $200K gain, it might be difficult for them to match up that $200K gain exactly with the property that they want.
Right. So say if you sold a property for $400,000, say you have a $200,000 mortgage, so you end up with $200,000 of cash. Well, you have to purchase a replacement property for $400,000 or more in order for it to be totally tax deferred. You have to reinvest from your sales price, not from your net proceeds. But if the property you're buying, instead of being $400,000, if it's only $395,000, then that would mean that there's $5,000 that you did not reinvest. And that $5,000 would be called boot, and that's money that you took out of real estate. And so that would be taxable income. So in that case, you would have a partially tax deferred exchange. You would pay tax on the $5,000 of boot, and the remainder of your gain, which in your example I think was $200,000 total, the remainder of your gain would be tax free.
Yeah, and I can think of another instance in which boot may be generated. If someone has this same $200K gain and say they wanted to buy a fourplex building and they're looking for an $800,000 fourplex building because that way they've got exactly the right amount for a 25% down payment. However, they can only find a $700,000 fourplex building. Well, therefore, they only need to make a $175K down payment. $25K could be subject to boot unless they choose to make more than 25% down payment and just move that money into the property, making more of a down payment than they needed to, but at least they avoided paying tax on that $25K. What do you think about that example?
That's correct. And they could do that. They could either reinvest more than the minimum that they needed to, or they could pay boot on the money they took off the table.
And generally, I like to not put any more into a down payment than what I absolutely have to because I want to optimize my leverage. But in this case, maybe I would make a greater than 25% down payment because I really wouldn't want to pay capital gains tax on that $25K.
Right.
Talk to us some more about the state tax issue, Steve, because there are probably some considerations for certain states. And then there are other states that don't have any state capital gains tax. And as a reminder, the 1031 tax deferred exchange basically exempts someone from paying federal capital gains tax, which is 15 to 20%, plus any state capital gains tax on top of it, which could be as low as 0, or the last time I checked, the state with the highest capital gains tax was 9.3% in California, plus it saves one from paying the depreciation recapture. But can you talk to us about that state-specific tax piece, Steve?
Different states have different rules. Most of the states accept 1031 treatments. So say in the state of Georgia, which is where I am, if I sell a property in Georgia and I buy a property in Florida, that's no problem. You know, Georgia accepts that. I don't have to pay Georgia tax on it as long as I did a 1031 exchange. Now, some states, California, Montana, Oregon, and Massachusetts, they have what they call clawback rules. And so if you sell a property in one of those 4 states and you do a 1031 exchange, they'll accept the exchange. But whenever you sell that property that you replaced it with, they expect you to pay tax on the gain that you deferred back to them, back to the home state. Like in California, they have you fill out a form every year that says, yeah, I still own that property that I deferred, and have you keep doing that. And then if you ever don't own that property, then they'll come at you for the state tax that you deferred previously. So those states are pretty aggressive in going after what they call this clawback rule. The other state that has an oddity is Pennsylvania. They don't accept 1031s at all. And so if you sell a property in Pennsylvania, and do a 1031, you'll defer your federal tax, but the state of Pennsylvania will charge you state income tax on that transaction. You just have to be aware, or the intermediaries have to be aware of these different state rules so that we can advise people on what to do and what the ramifications of what they're doing are.
Hey, that was enlightening to me. I did not know that about Pennsylvania, the state that I was born and raised in. That's quite the wrinkle there. Steve, are there any last things before I ask you about you and what you do there? Are there any last things that a listener should know about 1031 exchanges? Maybe something that I did not think about asking you, but should have?
Well, the only thing I'll reiterate what you said before is that with these 1031 exchanges, you're deferring the gain. It's not tax-free. Sometimes you'll hear people call it tax-free exchanges, but it's really a tax-deferred exchange. But if you continue to defer for your lifetime and leave it to your heirs, then they get a step-up in basis and the gain does disappear then. So that's a good planning strategy, I guess, as far as keeping the property until you die. And then you can avoid the tax on it entirely.
And it's really important for you, the investor, to involve your QI early on in the process. In fact, when you begin the process of relinquishing your property, oftentimes you want to have that written right into the contract that this sale is part of a 1031 exchange. And you got to remember to be sure to not touch any of those proceeds yourself. When you do make that sale, they need to go off to the QI. Otherwise, that entire amount is considered boot. So being proactive, being early is really important. And when you're selling the property you're relinquishing, that's also in fairness to your buyers so that they know what to expect and that they know what's coming. And in all my sales, I've never had any buyer say, oh, that's going to be a problem that you've got, that this is part of a 1031 in here. That just hasn't been the case in my experience.
Yeah, I've never had anybody question that either as to what the other party is doing because it doesn't really affect them.
Well, Steve, Andrea, our operations lead here, she first heard about you because you and your company was highly recommended to her by a lot of investors in Southeast Georgia. So Andrea went ahead and she used you for her recent exchange, and she was glowing about how you did a fantastic job. She said often you were responding to any of her urgent document requests within minutes, and the transaction was really smooth. You have a staff of about 30 people there, so you can really handle the incoming volume. You have any other things you want to tell us about your company and your experience? Experience is so important in an underregulated industry like this.
That's very true. We've been doing this for about 20 years. We've done thousands of these transactions over the years, and we do it in our CPA firms. So we are subject to the regulations of being a CPA firm and having our CPA certificates and licenses. So you have to be careful with some of these intermediaries that just put their shingle out there saying they're an intermediary. They don't necessarily have the training. They may, but they may not. And they may or may not have insurance or be bonded or any of those things. Well, we do it through our CPA firms, so we are insured and bonded and all that, and very experienced in it. Plus, we know the tax ramifications of all these transactions, and we can be involved in that and either talking to the person doing the exchange, or even sometimes we'll get on the phone with their CPAs and go over it with them. And so by us being well-versed in that area, I think it kind of works as a good team approach and a good thing that we've got going here. The firm has been here. We started in the 1950s, and so we've been here a long time and will continue to be here. There have been a couple of instances that got nationwide attention where intermediaries who just put up their shingle ended up taking people's money and disappearing. And so you want to be very careful that the person you deal with is not fly-by-night person or somebody who doesn't insure the money, or you want to check their reputation first. And I think you'll find that our reputation is rock solid.
Yeah, that's right. And you do that under the auspices of a CPA firm there. So you do have some purview. You can learn more about getting started at gremarketplace.com as one of our resources there in connecting you with this 1031 provider. Steve, before you go, can you tell us about the cost that one might expect for a 1031 exchange?
The cost is kind of based on the size of the transaction and the complexity of the transaction. It's about $1,500 is like the minimum cost, and then it goes up from there, and that would be a very plain vanilla basic one. And it could go up, if you're talking about a several $1 million transaction, you could be talking about $5,000 or so of fees. But you could also be talking about saving yourself hundreds of thousands of dollars of tax money. So the fees are very much worth it, I think. I generally don't have anybody complain about it or whatever because they realize that they're saving a lot more than they're spending.
It is a pretty low fee when you look at transaction costs yourself as an investor, especially compared with something like agent commissions and make-ready expenses. Well, Steve, this has been really valuable. Talking about 1031 tax-deferred exchanges, something that a lot of people don't know about. However, for a real estate investor, it's probably the greatest gift that the tax code is ever going to give you. Thanks so much for coming on to the show.
I enjoyed talking to you. Thank you.
Oh yeah, some great material from Steve here. I learned a couple things myself. I did not know about how the benefit works with your relatives or about the Pennsylvania state capital gains tax and how they still tax you at the state level with exchanges out of Pennsylvania. Understand that after you relinquish your sale property in an exchange within that 45-day identification period, you must be specific when you identify your replacement property. You cannot get all nebulous and say, yeah, I'm just going to exchange into a tan-colored house in the northern half of Florida or into a new construction duplex somewhere in Utah. You can't do that. You've got to state legal or street addresses of the replacements. Now, I know through experience that during that time when your money is at the QI, that up to 180 days, it is good to have some extra cash on hand in case you need to make up a shortfall for a down payment on the replacement property. And then on the other hand, if you have too much money with the QI and you're trying to get it all placed so that you don't have to pay taxes, well, you might make, for instance, a 27% down payment on the new property, even though you only had to make a 25% down payment. And why would you pay 2% more and lose that leverage? Why would you ever do that? Well, that's if you determine that it's better for you to do that and get the tax deferral on all of the money that the QI holds, having zero boot and paying zero tax. Like I said near the beginning of the show, there is no limit on the number of 1031s that you can do throughout your investor life. So get started and get in the habit of doing it if you think it's going to benefit you. Yeah, all at once, with one big trade up, you can create more cash flow, arbitrage, increase leverage, and increase your velocity of your money. But beware, there is no government oversight, no watchdog on QIs. Therefore, it is ultra important to have a reputable provider, that QI, help you through the process and act as the custodian and the holder of your funds throughout the exchange and steer you through it and answer any ongoing questions that you might have. Thanks so much for your listenership today. I truly appreciate you. At gremarketplace.com, get started with 1031s with today's provider by using the resources tab there. Or you can just go directly to gremarketplace.com/1031. That's gremarketplace.com/1031. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.